Hello, good morning, everyone. Welcome to all of you for today's session. Students, this is Hamzah Siddiq. Just let me know whether you people can hear me well. Can you hear me? Just let me know, please. You have to open your mic and respond, or you even respond in the chat box here as well. Yes, can you hear me? Okay, good. All right. Now, so students, before starting your lecture and today's topic for AFM, just let me know how many of you have gone through ACCA Study Hub. How many of you know about ACCA Study Hub? Tell me, please. How many of you know about that? Tell me, please. Yes. How many of you know about ACCA Study Hub? No one? Please, yes or no response. My question, please. Okay, one person no. Okay, they know, right? So students, ACCA Study Hub, all of you know. So just once again, I just want to go through with you people from that. So what you will be doing, you will be like opening my ACCA. Here is the login. Yes. And this is student's account. One student, by chance, the name is the same. So my qualification, you will go there. And here is the ACCA Study Hub. ACCA has given the study resources for the student, right? So here there are all resources of all subjects. So AFM, go to exam. Here it is. And here are the full study text of AFM in front of you, chapters. Here they are. And there are around 18 chapters of, yes, AFM, 18. And now, then there are quizzes, and this is the practice kit. You see here, 101 questions. And you see here, first of all, these questions we can see in one way here. Chapter-wise questions there are. Just a minute, please. Yes. Starting from here, actually, it is a revision question. These are the exam format revision. These are revision questions to be done later on. To be done later on. So what I was looking for, here they are, chapter 4, yes, study questions. Study questions there are revision question and additional questions. So 3 types of questions there are. For each chapter, there are questions given. I mean, you prepare a chapter and you solve these questions. And then later on, additional practice question material is, and wonderful material it is. In my opinion, there is no need of any exam kit and book now, because ACCA has taken the responsibility. They have given you, this is the benchmark by your accountancy body, and no one can produce an alternative to this. Now, listen, what I will be doing, I will be issuing, although I used to provide my full notes, course notes, and this time I will try, because I have to update, because this resource has been published 2 days back on 5th, right, by ACCA. So I am just working and updating my notes and trying to align with this ACCA's standardized guidance. So I'll see for that how it works, how it means that turns out to be. Because I am thinking that I will provide some notes in simplified words. Yes. And of course, reference book will be ACCA. And my notes will be, you will be first of all studying my notes and then referring back to ACCA's website, this study text. This is how we will proceed. For practice questions, now there is no kit required. Now, so you will, that's why I have not provided you today study plan and notes in the first class. Otherwise, I normally provide in all sessions, because I have to work out. It will take 1 week. Before next class, you will have some handout and your study plan as well. So today, but of course, we are going to study today. So I will be explaining you the syllabus. If we focus, let me open Excel sheet here. Now, students, advanced financial management. AFM. Student, this subject we can categorize into the following areas. Number 1, I call it investment appraisal and WACC, weighted average cost of capital. The second section is I call risk management, which include interest rate risk management, foreign currency risk management, and its hedging as well. Then third section I call mergers and acquisition. Although there is a separate section, fourth, but that I can include that because that is extension of this as well. That is called reconstruction, corporate reconstruction. Corporate reconstruction. And then fourth section of your syllabus is That is theoretical areas. And it is a big portion. There are so many topics theoretically. Ethics is there, corporate governance is there, sustainability is there. Means these are generic topics. But there are some topics, for example, IMF. What is the role of IMF? What is World Bank? Means they are just introduction of some financial environment as well. So it has a major contribution, major part of your syllabus now. So students, when we talk about AFM, so AFM is basically, again, the paper has 80 technical marks and 20 professional marks. 80 technical marks and 20 technical marks. So this 80 technical marks, when we talk about it, so I normally say that you need to learn how to draft. First of all, technical knowledge. Okay, knowledge. Now, how to draft answer. A few additional things, a few that you will serve and bring you marks for it. So ultimately, if you work very well, so it is automatically means that aligned with that, it will be covered. Now, next, the next point. So students, how we will be proceeding through the syllabus. Remember, AFM requires study hours. First of all, class, lectures. Around 60 hours minimum, I'm telling you, they will be required. So I will be conducting, starting today, 3-hour class. And then I will be conducting an additional class per week. And I'm telling you, I will give you the schedule course of classes by next class. Because today I was too much overoccupied and ACC has since introduced these changes. So I have to account for that. I'm working on that in detail. So minimum 60 hours live session. So, but that's not enough. I don't say this thing to any other class normally. Because I know AFM is a very interesting subject. And pass rate for AFM is higher than AAA and APM, Advanced Performance Management. Rather, if I say it is higher in all 4 optional papers, I think it is equivalent to the ATX, Advanced Taxation pass rate. So 60 hours regular classes, and I recommend all of you to do crash course as well. Normally 24 hours additional, that is additional practice. Right? So this total becomes 84 hours. Sometimes it happens, in the past, I have done it, that I promised student 24-hour crash course, but I prolonged it to 30 hours. I took 6 hours additional because I thought more practice to be done. So that's why, so you people have not enrolled, some of you have enrolled for normal course right now, and some are on trial basis. So I'm telling you in advance. Because, I want you to pass paper, and pass rate is the highest for AFM in the optional paper of ACCA. And you will be surprised. Now, next. Then is self-study. How much time you need to spend. If I say, on average, a student need to spend minimum 140 hours. Right? On average, some 130, 120 hours self-study. But it should not be like that. I spent 30 hours in January on study, then 30 hours in May, for example. No, these 140 hours in 4 to 5 months time, consecutive. If you have studied 2 months or 45 hours in January, February, and then you go, okay, I will do remaining in September. Previously, 45 hours wasted. You would be starting afresh, I'm telling you. Count starts afresh. This applies to all subjects. This is what the blunder which is done by normally my Mauritian students. They don't spend enough time, which I tell them to pass a paper. And they expect it to pass. Yes, they pass sometime. Chances, luck is there. And they pass by 51, 52, 53 marks. But it does not happen every time. So in order to prepare this subject properly, 140 to 160 hours self-study is required. Remember, this on average required. If you spend more, wonderful, you will get more and more marks. Now, so students, this is how it will work. Now, how you will be, before I proceed to the technical area of the syllabus, AFM class, live class is 3 hours on Sunday, morning 8:15 to 11:15, this is the time allocated. And I will give some additional class plan as well. Then at what time you will be doing self-study? Similarly, I am allocating the class time. You will be allocating self-study time. That at what time during the week you will be studying the subject yourself and revising the lecture. Otherwise, what will happen? And it happens in every subject, by the way. That you attend 1, 2, 3, 4, 5, 6 classes, and after 6 classes, you getting lost in the lecture. You say, oh, I did not remember. I do not. What Mr. Hamzah is teaching? Oh my God, he's not explaining things well. And actually, what happens? A teacher keep explaining based on the assumption the previous lectures have been prepared by the student, which I have already delivered. And then you start losing the interest in the subject and in the class. You start being absent from the class. And you say, okay, I will miss the class. I have to cover previous lecture. Then I will watch the video because video is provided. It's been 5 years I am conducting online classes. And more than 5,000 students have studied with us in these 5 years. More than 5,000. We have data proper, we can analyze. So based on that history, I am telling you, these are the traps. The first trap is you do not study at home regularly. The second trap is, you are getting lost during the lecture then, because you are unable to comprehend the next lecture properly, which is linked with the previous. When you start being absent, then you start being absent. And then you say, oh my God, there are so many lectures. How can I cover? And then the session ends and your access to the courses ended. And so, oh my God, I have wasted my money. You got my point? This happens. Now, this is our analysis based on a sample, not a sample, a population of 5,000 students. Right? Now, so students, the point is, so that's why from day one, you have to, there is one word I will say, you have to discipline yourself. I ask you one question. What drives you in life? Ask this question to you. Is it motivation? Or is it discipline? Ask yourself. Motivation level goes up and down. Sometimes you are demotivated. Sometimes you are hyper motivated. And you work according to that. And that's why you miss your targets. Discipline keeps you on track. That whether I am demotivated, I have to work. I have to devote this time. I need to make myself work. So discipline should be the biggest motivation. Right? That plan it and stick with it. Now, I hope it is clear. So students, we will be starting with the area that is investment appraisal. That is the investment appraisal. And what I will be doing, I normally teach AFM in the Excel sheet. In the Excel sheet, I normally teach that. And I share a Google Drive or OneDrive link with the students of those Excel sheets as well. They can open whenever they want. They can check the calculations, but it doesn't mean you have not to note down the lecture. Remember, lecture has to be noted down to stay connected, to stay involved. When you are not noting down the lecture, it is the best way to get distracted. Okay? So let us start. Let us start discussing this. Yes. I will be opening an Excel sheet. Just 1 minute, please. Then I'll share my screen with you. Yes. Here we are. Students, I am starting discussion on advanced investment appraisal, but I will be showing you where I am starting from the notes from this book, but I will be sharing with you notes as well. This is the chapter number 5, right? So, student, investment appraisal. Student, what is investment appraisal? A business wants to purchase furniture for office. Is it investment? Tell me. Here, in this sense, is it investment? No, it is not. Investment appraisal is basically some business is going to be launched. Some business is going to be launched. This is, or some factory they are going to establish, some outlet they are going to open, some machinery they want to purchase. So investment appraisal, that whether the investment will be financially beneficial and it should be accepted or not. This is basically evaluation. There are two types of methods. One are called discounting techniques and non-discounting techniques. Yes. Discounting techniques and non-discounting techniques. What are the discounting techniques? Where time value of money is considered, time value of money is not considered. Yes. Time value of money is not considered. That is called non-discounting techniques. What are non-discounting techniques? Payback period method, accounting rate of return. These two non-discounting techniques are part of our syllabus. Yes. Then discounting techniques, discounted payback period method. Then is NPV, net present value, IRR, MIRR. Sorry, one I missed. Yes, that is a duration. So these are discounted techniques in your syllabus. Now we will talk one by one each technique. First of all, tell me what is time value of money? Tell me. Yes, today's money has more value than tomorrow's. This is time value of money. Today's $1 has more value than tomorrow's $1. It is the point. Time value of. So when it is the case, why? Because of inflation. Today's money has more value than tomorrow because of, number one, inflation, because of risk. Today you are getting the money, tomorrow you will get or not. There is a promise, there is hope, but still a bird in hand is better than a bird in the bush. Next. Then the third reason is opportunity for investment. You can have money today, you can invest and double till tomorrow. But tomorrow you are going to get one. They say get $1 today or tomorrow $1. You say today. Why? Because today I can invest now. So time value of money exists because of these three factors. Now, so students, so let us start with these techniques. So I will be discussing first of all accounting rate of return. ARR. It has another name, ROCE, return on capital employed as well. Another name is return on capital employed, ROCE. Now, so students, the point is, so ARR is basically the only investment appraisal technique which is based on profits. It is the only technique which is based on profits. Now, so it tells the percentage of profit of the project to its initial or average investment. Yes. It is percentage of profit of the project, annual percentage, sorry, annual. Yes. The word annual percentage. That this is the project will yield me percentage return every percentage profit. So for example, so the formula ARR, of course you should need to memorize. That is average annual profit of the project divided by initial investment into 100. There is another formula. ARR is equal to average annual profit divided by average investment normally into 100. This is preferable formula, most commonly used. If examiner is silent, we will use this. If examiner specifically tells, then we use initial investment, then we will use this. Now, students, for example, a project has here and profits. Here 1, 2, 3, 4, 5. For example, the profits are 2,500, 3,750, 3475 4920, and there is 4300. These are the forecasted profits. Forecast. Basically, project is to be launched. For example, initial investment in the project is 13,500. Scrap value or residual value of the project at the end is 1,500. Now, make it, just a minute, make it 18,000. Yes. Now, so what will be the ARR? ARR based on initial investment, we need to calculate. First of all, we calculate average annual profit. How to calculate? Sum from this to this, right? Divided by 5. 5 years. So average annual profit. Students, wherever you feel like that I have done a calculation, applied a formula, and I have pressed enter very quickly, do tell me and get explanation of that formula. Don't stay silent. I will try to explain formula, but sometimes I may feel like it is quite easy, and I do it quickly. Now, here you go. Average annual profit. So based on initial investment, this divided by initial investment. Yes. So it is the percentage is 20.5% ARR. So the second one, we have to calculate average investment. How to calculate average investment? Average investment is equal to initial investment plus scrap value divided by 2. Initial investment plus scrap value divided by 2. This is the average investment. Now, so average investment, let us calculate. This plus this divided by 2. Here we are. This is the average investment. Just see here. Then, accounting rate of return is equal to average annual profit divided by this. Based on average. Yes. Percentage. Yes. Is it clear to everyone? Tell me. Is it clear so far? What is the decision criteria that whether to accept a project? So we have not to calculate both in exam. We normally calculate this one in exam. This one. When they ask calculate ARR rows, we calculate this one. This is calculated only when examiners specifically say use initial investment. Otherwise, we do not calculate this. Okay, now, so ARR, let us proceed further. Students, if project ARR is greater than target ARR, greater than or equal to ARR of company, we accept the project. Otherwise, reject. Simple as that. For example, here in this case, the target ARR is that is equal to 25%. So on this basis, we say accept it. Project is yielding more than the target. But if examiner has asked to calculate on this basis, then we will say reject it, because it is less than the targets. I hope it is clear to you people. Now, so students, I told you, this is the only technique which is based on profits. All other are based on cash flows. Tell me, what is the difference between cash flows and profits? Tell me, what is the difference? Tell me, please. What is the difference? What do you think? Anyone, please? You can even open your mic and talk to me. I'll be happy to hear from you. Exactly, in the profit, not includes. In the profit calculation, depreciation has been excluded. Okay, so cash flows minus depreciation, that is equal to profits. Okay? Yes. Now, students, yeah, exactly. So when we, in the cash flows, we deduct depreciation, we get profits. In other words, yes. So cash flows equal to profit plus depreciation. Yes. In other words, if we want cash flows, we get this way. If we want profits from cash flows, this is the formula. Rearranging the same. Note down these formulas. Now, so then, for example, in exam, they have given to you people that year 1, 2, 3, and 4. Cash flows are given. That is 7,500, 7,700, 8,150, 8,383. These are the cash flows. Initial investment, that is, for example, that is 16,000. Scrap value is 2,100. and they say calculate ARR based on average investment. For example, they are silent. Simple. So we will calculate based on average. Now, students, this is the example 2. Now, so students, how to calculate cash flows? We cannot use that to. Yes. So how to calculate? First of all, we need total cash flows. Sum this to this. I have just added all. Now listen. What is the depreciation? Initial value minus scrap value is the depreciation. Initial value of the machinery and value at that, the difference is depreciation. Difference is depreciation. Now, so total profits. We have learned this formula. This cash flows minus depreciation is equal to profits. This is the total profits. Cash flow minus depreciation is equal to profits. We have learned that. Now, so students, average annual profit. Now, average annual profit we need to calculate. This divided by 4 year. Average annual profit. Now, average investment. How to calculate? Initial investment plus scrap value. Plus scrap value divided by 2. Average investment. ARR. Average annual profit divided by average investment. Here we are. 49%. Yes. Here we are. Is that clear? Tell me. Is that clear to everyone? So, students, let me take you to the return on capital allowance, ROCE. So they say it includes sunk costs, allocated overheads, amortization, total profit formula. Here we are, just here it is. Cash flow minus depreciation. Cash flow minus depreciation will come. Now, the formulas are given here. Decision rule. Example is also given here. Now, I want you to solve it for me. Be quick. This one. Rows on initial investment and average investment. Be quick. Be quick. Yes. I'm waiting for your answers. Be quick. Everyone will be sharing the answer. Waiting for your answers. Be quick, please. Why you have taken those so much time? Okay, I have received the answers, and some of you have not considered cash flows have been given. First of all, they have to be converted into ever profits. So you see here, this is the solution. First of all, depreciation. Okay, they have done in another way. My method was a bit different. Okay, so let me solve in my method. That was more straightforward. Yes. So first of all, what we will be doing, we will be calculating total cash flows. Tell me, how much is the total cash flow? Tell me. You have calculated total cash flows. Tell me, please. Sum of all cash flows, adding these 4 year 250 or 250, year 1 to year 4, add these 4 cash flows, it is 250. 250. Yes. Initial investment is given. Initial investment. Sorry. And scrap value, both are given. So initial investment is 200. Scrap value is 20. So yes. So what is the depreciation? That is equal to this minus this. Now, so total profits. Cash flows minus depreciation. So average annual profit. That is equal to this divided by 4. 4 years there are. Yes. So based on initial investment, rows based on initial investment. This divided by average annual profit divided by initial investment. Here we are. Yes, 8.75%. So now average investment we need to calculate. Initial investment plus scrap value divided by 2. Right? So rows based on average investment, that is equal to annual profit divided by average investment. Here we are. Here we are. Is there any confusion? Do let me know. Now, is there any confusion? Do let me know, please. Now, so the rows is done. Now the next stop, yes, it's drawbacks. So I will pick from here and I will explain. Benefits are simple to calculate, easily understandable. Yes, there are different methods of calculation, 2 different methods. Initial investment and average investment. So it causes confusion which one to use. It is based on profits, and profits can be manipulated easily by using any non-cash expense. It is not based on cash flows. It ignores time value of money. Yes, no discounting. We did not do any discounting. Target ARR, which is set by the company. What is the target? Which should be the target? It is based on judgment of the board. Target ARR is based on judgment, and judgment may be, yes, it is a relative measure. So very important to which you need to memorize. It is profits based technique which can be manipulated by accounting conventions in accounting terminology, which can be manipulated profit. Second, it does not consider time value of money. Target ARR is based on judgment. Which how much is enough? This one, 10%, 20%, 30%. What do you decide? It's your choice. Based on your judgment, it will be decided. Next. The next point is just 1 minute, please. Yes. That it is a relative measure. The answer is in percentage rather than exact impact on shareholders' wealth. These concepts should be very much clear, because AFM is analytical paper, analysis, discussion. It's not just calculation. Yes, calculation supports the analysis. Calculation is a major part, bigger in us. It is a big part. But calculation only is not enough. You should be able to analyze the situation. Now, so student, the next method of investment appraisal is payback period method. Yes. So payback, what is payback? It is time required to recover initial investment of the project. That we are going to invest this money today. How much time this money, what we are investing, it will be recovered. This is the first, we can say, interest of anyone. That in how much time my initial money which I'm going to invest today, that will be recovered. This is our first interest. Now, let us proceed further. So payback period method of investment appraisal. Now, so students, this method of investment appraisal, again, board, we are going to launch a project for which initial investment is required is, for example, 2,500 million, and cash flows are as follows. Yes. Now, the students, year 1, 2, 3, and 4, and 5. So cash flows of the project. Now, for example, it is age 20, 951, 1179, and age 80, 1240. For example, these are the cash flows of the project, right? Now, the point is we need to calculate payback period. So year 0 is the investment. Year 0 is the investment. Now we will make a cumulative cash flow column here. Cumulative cash flow column here. This cumulative means total to date. Initially, this is outflow. Then this will be received out of this. This will be received and remaining will become negative total to date. This will be received and here we are. Now you see here 2-year complete. 2-year complete plus 729 we need 729. In the next year, how much there are? 1179. 1179 we cannot recover. We do not need. How much we need? 729. It means part of year 3 will be utilized. Part of year 3. 0.62. So 2.62 years is the payback period of the project. Payback. In 2.62 years, it will recover it. Now, what is 0.62? How many months? 2 years. Okay, we can calculate months. You can do this. There are 12 months in a year. Around 8 months. We will not do it 7 months. Why? Because it is not rounding off on number just. It is months in which investment will be recovered. 8 months. So 2 years and 8 months. 2.62 years or 2 years and 8 months. If examiner does not ask you that whether to calculate this way or this way, choice is yours. In any way you can calculate, if they do not specify. Now, so payback period of investment appraisal. Let me go to the notes and yes, here is the payback period. If payback, again, target is set by the board that we will, yes, the board say, okay, we will accept the project with 3-year payback or less. So students, if payback of the project is less than target payback, we will less than accept the project. Or vice versa. Accept the project. or vice versa. Anyone, any confusion or any question? This is very easy. If the annual cash flow is same, for example, a project, another example. Oh, sorry, I wrote less and typed inverse. You're right. Less than. I'm sorry. Okay, example 2. Very easy. Students, if a project has initial investment of 10 million, annual cash flow will be the same. That is 1.5 million. What is the payback? In how much time? So payback is very easy. 10 we need. Annual we are getting 1.5. Annual we are getting 1.5. 6.67 years. 6.67 years. Very easy. We need million. Annual we are getting. So in 6.67 year, our money will be recovered. If annual cash flow is the same. When it is different, then we have to prepare a cumulative cash flow column. Normally in exam, it is like this at AFM level. Now, so next. So students, one more example which you will solve. Cash flows are given here. Here 0, 1, 2, 3, 4, 5. Minus 129 is the investment. $24.5, 47.9, then 59.2 million, then 20.5, then 34.8. These are the cash flows in millions. Calculate payback period of the project. Be quick. Student, always calculate in the Excel sheet. Always calculate in the Excel sheet. And I know when I give the question like this, you may face a problem. The problem might be like that. You might be facing issue in copy and pasting there, noting down. So use split screen option. Split screen option. Use that. If you are using Windows, if you're using Mac, it is quite easy. Split screen. You simply come here on this icon. It will give you the option. Yes. Yes, you see here. Tile window to the right and left. Okay, there is an option. But if you're using window, so window sign and arrow, right and left. Window sign and right and left. You can use split screen. Mean my screen will also be open there, and you can open Excel sheet along with that, your own. Window plus arrows. Window button along with the yes. Calculate and give me payback period of this product. Be quick, please. I'm waiting. Now, is it okay? Is it good now? Yes. I hope it's okay. I'm sorry, Yes. So here we are. So you see here, cumulative cash flows, we have to create. We need 56.6, here 59.2. So part of year 3 divided by 59.2. 56.6? Yes. So 2.95 years. 2.95 years. That is the payback. Simple as that. Simple as that. Now, it's quite easy. I don't know why you are unable to calculate. There was no rocket science in it. So come. Student K, yes. It is easy to calculate, simple. Very important. Payback period, we say shorter the payback, project is good. Means cash flows are, investment is recovering very soon. Investment is recovering very soon. It means shorter the payback. So it ensures liquidity. Earlier cash flows. Now, and I will write here one more advantage. It reduces the risk by recommending projects with smaller payback or shorter payback period. Risk. Shorter payback period means your investment will not be tied up for longer. So the risk is reduced. Now, I'm sorry. Next. The next point is yes, drawbacks. Again, target payback. How much is acceptable payback? It is subjective, judgment. So no impact on it does not discuss what is the impact on shareholders' wealth. Ignores time value of money. And student, this is very important. It ignores time value of money. It does not consider full life of project. Yes, it is concerned only payback period and ignores the cash flows after payback period. Now, it does not tell what is happening with the project after 2.95 years, whether zero or something else, what we are getting in after payback period. There's a problem. Student, then there came discounted payback period method. Discounted payback period method. Now, discounted payback period method, basically, it talks about, it considers time value of money and calculates payback of a project after considering project with discounted cash flows. Yes. So it considers time value of money and calculates cash flow payback of a project. Now, just see here. For example, I will take the same cash flows, this one. And cost of capital is 10%, for example. So first of all, we will calculate present value of cash flows. Do you remember formula? Present value is equal to future value into 1 plus r raised to power minus n. Sorry. Do you remember that? Present value is equal to future value into 1 plus r raised to power minus n. Yes. Here we are. So this future value into 1 plus r, 10%. Right? 1 plus 10%. Raised to power minus n. And is number of year. Applying the formula. Perks of working in spreadsheet. Here we are. I have applied this formula. Yes. Now, so cumulative cash flow column will be made now on it. This plus this. This plus this plus this. Oh my God. This plus this. So 4 year complete. It is 8.66. 21 point this. So 4.4 years. If there is any confusion, any question, do ask. If there is any confusion, anyone, any question, please ask. Yes, please. And again, if payback target, you see here, same project. Here payback period was this. This is the discounted payback. Yes. This is discounted payback, which is greater than normal payback, because it is based on present values. And present values are less on smaller amounts. Now, so students, and it removed this drawback. Now it considers time value, but still there is a problem. It ignores cash flows after payback period. Same problem is there. So here comes then duration. The next topic is duration. Duration is weighted average time to recover present value of cash flows of a project. Weighted average time. Yes. Weighted average time to recover cash flows of a project. How to explain it? What does it mean? I will talk about it in a while. I will explain it once I do this. So students, for example, this is a project and cash flows are given. Minus for the investment is 1800, then is investment is this, right? Then is 300, 450, 590, and 880. Remember, here we ignore initial investment. We ignore, yes, we use only return phase of project. What does it mean? The meaning is that return phase starts when first positive cash flow occurs. From year one, return phase started. Another project, for example, its return phase. We will talk. Let me give you another example. For example, its return phase is 9 minus, I told you 1800. Its return phase is starting from here. Minus 1100, minus 900, minus 200. 5, 6, and 7. For example, its return phase is starting here. When first positive cash flow occurs. Okay. So 80, for example, it is 921, 450, and 600. So I have given you two examples. Example one. This is example one. just to show you bigger figures. Yes. Now, students, this is the example 1. This is example 2. So I will solve for the both. First of all, return phase. Its return phase is starting from here. Example 2. Right? Another example, example 3. $300 positive, negative 470. Another cash flow is negative here. Now, its return phase is starting here. First positive cash flow occur. Although there is negative later on, but when first positive cash flow occur. Now, so I will solve duration for this one and this one, example 1 and 3. For 2, you will solve yourself. Now, so let us start with example number 1. For example, cost of capital, I assume that is equal to 10%. So what I will be doing, I will be taking example 1 from here to here. Yes. Now, so we will delete it. We take only return phase. Now, present value of cash flows. First of all, present value. This future value into 1 plus R, 10%, raised to power minus N. Present value of cash flows is here. Yes, the same formula. And here we are. Present value of cash flows. So total present value of return phase total present value of return phase 1689. Now weighted average, how to calculate? This divided by 1689 total multiplied by number of years. Note it down. Multiplied by number of years. This divided by this, multiplied by number of years. I will simply drag it. You see here. This divided by 1689 into number of years, relevant year, and so on. This divided by total present value into number of years. Here is the duration. .81. 2.81. Now, it is weighted average time to recover. Basically, how to interpretation. Now, interpretation. How to interpret? I will explain. If duration of a project is greater than half of the life of project, It means its majority cash flows are in the later years of project life. See, 2.81. What is half of the life? 2. 4 year, half is 2. 2.81. Majority 2.81 indicates majority cash flows are in the later years. Smaller in the here. And if duration of a project is less than half of life of a project, it means its majority cash flows are in the earlier years of project life. Now, is it clear? Is it clear so far? Silence is not good. Example 3. I will be solving. If there is any confusion, ask the question, please. Example 3. Yes. Example 3. So cost of capital, I will take 10%. We need to calculate duration. So present value at the rate of 10%. This, we have to take only return phase. Only return phase will be ignored initially. So present value, cash flows, future value into 1 plus R, 10%, raised to power minus this, N. And so on. Yes. So total present value is equal to sum. It is 1504. 1504. So weighted average. This divided by 1504 multiplied by relevant number of years. Simple as that. Now, duration is here. 4.708. More than half of the life of the project again. So its our cash flows are also in the later years of the project, in the last years, majority cash flows. Students, duration considers full life of the project, time value of money, but it does not tell the impact on shareholders' wealth. Yes, duration is done. Present value divided, calculate it. First of all, steps. Calculate present value of each year cash flow. For return phase. For return phase, calculate total present value of cash flows. Then divide each present value, each year present value with total present value and relevant number of year. Then calculate a sum of above fractions to get duration. 4 steps. 1, 2, 3, and 4. Simple is that. Note it down. Students, if you have noted it down, I am writing a question for you. Minus 3,000, 8,500, 9,700. So it is 30,000, sorry. 30,000? Yes. Then it is 5,000. Make it 12,700. Yes. 500,000. 5,500 and 6,000. Make it 11,500. Now it will be good. Yes. So cost of capital is 8%. Calculate duration of the project. Be quick and interpret that. Be quick, everyone. I'm waiting for your answer. Be quick, everyone. Be quick, please. Yes. Only one answer received so far. You people take too much time in responding. I want answers. All the steps given here in front of you. Present value at the rate of 8% equal to this into 1.08 raised to power minus this. Here we are. So total present value will be here. Right? Now, weighted average. This divided by this, the 33632. 632 into multiply with the number of year. This step 3. Now, duration will be the sum of all. $2.046. Now, how to interpret? It means cash flows of project majority are in the earlier years of its life. Why? Because it is less than half. Half is 2.5. 2.406. 2.406. Yes. So then duration is done. The next is net present value. Last topic for today, NPV. Net present value is last topic for today. But in the next class, of course, we will do it complete 3 hours. The reason of less hours because you don't have notes. And but I will give you some homework. Remember that. NPV is, it tells the exact impact of a project on shareholders' wealth. Yes. So NPV is equal to present value of cash inflows minus present value of investment. So then exact impact. For example, this is a project. Let me take this one. I have to take the example above. This is a project. Investment is 25,000. These are the cash flows. And present value at the rate of 10%, for example. This into 1.1 raised to power minus NPV. I normally say do this. 7181. So shareholders' wealth will increase by 7189.1. So the project should be accepted. So NPV is positive, probably. If NPV is positive, it means it will result an increase in the shareholders' wealth by this amount, whatever positive it is. Current wealth plus this. So accept the project. Other if it is negative, if NPV is negative, reject the project. Reject the project. We cannot proceed with that. We cannot proceed with that. Now, so net cash flows we need to calculate. Again and again, we talked about a bit old topic of the project. How we calculate? We consider only relevant cash flows. It is a topic from F2, which are incremental future cash flows, which have to be incurred and are a direct consequence of investment decision. They are considered residual value, fixed incremental cost, allocated costs are not considered. Sunk cost, past cost, feasibility cost, they are not considered. They're sunk. They are not a direct consequence of investment decision. Overheads allocated, no, not considered. Depreciation, amortization, not because they're not cash flows. Right? So, students, that's the end of today's lecture. In the next class, I will start with the IRR, MIRR, risk and uncertainty in investment appraisal. But I will give you, this is the topics for the next class. And if we have time, I may go for capital rationing as well. So next class is going to be very interesting if you revise today's lecture. Let me tell you, chapter number 5, you will start reading at home. Discount factors, this is revision of earlier, okay, time value of money now. So NPV, performance given to you people, right? Some definitions. layout, okay, discount factors, overheads, spreadsheet formulas. I have already explained it to you in my spreadsheet. NPV definitions, accept, reject, IRR. So IRR method is given here. I will explain it in the next class, but yes, you don't have to study at home. So let me tell you what you have to study at home. You have to study starting from here, non 5.1, note it down, 5.2, 5.3, 5.5 as well. Right? 5.1, 2, 3, and 5.5 you will be doing at home. Okay. So in the next class, I will be covering a lot of these things. Okay. 6.5 I'll be doing duration. I have already done with, duration I have covered. Modified duration I have not done, but I will be doing that as well, of course, in the future. Anyways, so students, that's it for today. I want to know you people, because some of you are my old students, some are new, seem to be new faces. So I just want you to open your mic and introduce yourself, your good name, where are you working, in what capacity, and third, is it your first time with me in my online classes, or second time or third time, or you have said it before? So please, let us start with the alphabetic order. You're starting with the Fatima. Yes, please, Fatima. Open your mic, introduce yourself. Yes.
Hello, Hamza. It's
Hello.
Fatima. I'm from Mauritius, so I work as an auditor at BDO. And it's not my first time with you, as you know. I had several classes with you previously for AAA and SBR, amongst others.
Okay, you have studied AAA with me, right?
Yeah, yeah.
Oh, okay. Welcome. Thank you, Fatima. Yes.
Thank you.
Next is, thank you, Hansa. I'm sorry if I mispronounced your name.
No, you have
Yes,
correctly
Hans.
pronounced it. Hello,
Okay.
I'm Hamzah. It's my first class with you. I work in a financial institution.
Which one?
It's in finance
Okay,
from
great.
Mauritius.
Thank you.
Okay.
Yes, Kishini. Yes, please.
Hello everyone, I'm from Mauritius. This is my first time with you, and I work as accountant at Vistra.
And then how did you come to know about my classes?
I have some friends who have mentioned.
Oh,
that's
okay. Thank you, dear. Yes, I'm sorry, Kritika, if I'm not wrong. Kritika, yes.
Hi everyone. I'm from Mauritius as well, but I'm currently based in Malta. I'm currently working as an accountant there. So quite early for me here. But I've taken, So I've taken advanced performance management before. So this is my second class of the academy. Thank you.
Thank you. Yes, next is Kudzi. I'm sorry, Chamba. I'm sorry. Yes, please.
Hello, Hamza. My name is Kudzi Chamba. I'm from Zimbabwe. I work as an accountant in a mining company.
Right. So how did you come to know? It is your first time with us, or before?
It's my second time, but the first time I didn't. I later left the class, but this is my second time.
Okay. Thank you. Yes, Pragati. Yes.
Hello, sir. So I'm from Mauritius as well. I'm Pragati. I work as an auditor at PwC, and it's my first time as class as well.
Okay, so how did you come to know? about this?
I've seen revision videos and all on social media, so
Oh, okay,
it's
okay,
on
okay.
that.
Right. Thank you. Thank you. Yes, Priya Darshi. I think this name seems familiar.
Hi, Hamza. Yeah, I'm
Hello.
Priya. I'm from Mauritius. I work as an auditor in BDO Mauritius. So this
Right.
is my second time. I did crash course earlier for AAA.
Yeah, this name was,
Mm-hmm.
familiar. Thank you.
Yeah.
Thank you. Thank you.
Thank you so much.
Yes. Thank you. Shane. Yes, please.
Hello, sir. I am Shane from Mauritius. I am an auditor from PwC Mauritius, and I followed
Right.
some crash courses at Hamzah.
Okay. Right. Thank you. Thank you. Thank you. Yes, Tahir. Yes, please. Tahir, please. Can you hear me? Don't know. What is the issue? Yes, Vishnavi, please.
Hello, sir. It's Vaishnavi here. I'm also a student. I'm starting my bar course in November. And it's my first time with you. My cousin brother recommended your class.
Okay, your brother recommended. Okay.
Yes.
Yes, Warish, my old student.
Yes, you remember me. Good morning.
Yeah. Good
I'm
morning. Good
Warish
morning.
from Mauritius. I'm currently
Yeah.
an accounting work at IQQ in the accounting
Oh,
department.
IK.
Yes.
Okay, thank you everyone for joining me for the first session. So in the next class, we are going to meet with high ambitions, high spirit, but do revise. Okay, just 1 minute. Let me send with you people this first document of the first class, which I have actually prepared for you people, so that you can take help from it. Well, I will be sharing, once you people are enrolled, I will be sharing with you OneDrive link, so that every class document you will be finding there. Okay, in that, basically. Yes, 9th July. Here you go. It's coming on the way. Just download it, be quick. And once you download, write done in the chat box. Good. So students, thank you. I hope everyone has downloaded it. God bless you. See you next Sunday. Till then, take care. Goodbye. Goodbye.